In this short video, we will discuss weather risk management. We will first define weather risk and then move on to discuss weather risk management and the tools that can be used to mitigate exposure to weather conditions. We will touch on the companies that are exposed to weather risk and the types of derivatives that are used by these companies to hedge their weather exposure. Weather risk is the risk that is created when revenues and/or profits are sensitive to weather conditions. This could include above normal heat or below normal cold weather conditions. It is also includes hurricanes as well as drought conditions. To hedge the exposure to these weather events, some companies use weather derivatives, which are financial products that allow companies to manage or hedge their weather-related risk exposures. The value of a weather derivative depends on the value of the underlying weather statistic. Given that there are so many different weather conditions that can hamper the ability of a company to generate income during a weather event, customized weather derivatives are sometimes necessary. Weather derivatives protect against abnormal weather outcomes. Weather derivative risk can focus on average temperature, which is heating degree days divided by cooling degree days. They can focus on abnormal temperatures, which are the number of days above 100 degrees Fahrenheit, for example. Weather derivatives can focus on precipitation in the form of rain or snowfall, along with wind speed, or a combination of all those types of weather events. Weather derivative end users include utilities and energy companies, which are greatly affected by weather events. Utilities are affected by abnormal weather conditions often. During the summer, utilities expect hot weather to deliver a standard amount of electricity usage, and during the winter, these companies expect cool weather to deliver standard levels of natural gas usage. If summers are cooler than normal or winters are hotter than normal, the weather generated by utilities will be lower than expected. Agricultural companies are also affected and rely on a specific amount of rain or normal heating and cooling days to grow crops or use crops all over the world. A drought or a flood can cripple a crop, driving up or down the prices of grains, as seen during the summer of 2012. Despite a large increase in the price of crops, which usually affects the crop end users, if the volume of crops are mitigated, a farmer can be crippled as well. Seasonal clothing manufacturers also can be affected by weather, as warmer than expected weather in the winter will erode clothing sales. Insurance companies can also have enormous weather exposure, which can affect their ultimate bottom line. Weather derivatives are mainly used as tools to hedge weather exposure, but they also can be used as a speculative tool. Most temperature contracts in current practice are based on heating degree days, which protect in the winter, or cooling degree days, which protect in the summer. A heating degree day is anywhere between 0 and 65 as an average temperature in the day. Cooling degrees days equals the average temperature of the day minus 65. Derivative products in the weather market use the standard index to create swaps and options on a weather index. Both swaps and options in the market are Asian style, which is average price, which means the contracts use the average index during the course of a period, which is usually monthly, to generate a single fixed price, which is measured against a floating price to create a floating price by the index. The payoff for many of these contracts is based on a measurable cooling degree day or heating degree day index and how the index performs relative to a fixed price or a strike price, not on the actual loss. Coverage usually is defined at a particular maximum limit. With a swap structure, the fixed price payer chooses a level and pays the floating price payer in the number of heating degree days or cooling degree days if it is above or below a specific level during that particular period. In an option structure, it will be slightly different, as the purchaser of the option will pay a specific premium and receive a payout that is based on the index, which is a function of heating degree days or cooling degree days that is above or below the strike price level. Weather risk is a common risk that affects a number of companies across the globe. Weather derivatives, which have been created over the last 20 years, are a key tool that can be used to help companies affected by weather to mitigate their weather risk exposure.